I was struggling with my Forex trading until I realized there's one thing. There's a difference between how retail concept traders see the charts compared to how smart money and institutional concept traders see the charts. Let's get into that right now. Alright family, what's good liquidity gang? So we are back again with another video. This video actually derived from a comment that one of my subscribers dropped, and basically what they said is, look, can you break down how retail traders would have seen this chart compared to how smart money or institutional concept traders see the charts? That's what I'm going to be doing today. Okay, so we're in a 4-hour time frame right now, and what I'm going to do is I'm going to mark up like market structure and everything else, but I just wanted to show you a part that retail would have been thriving on. They would have loved it. So right here, what do we have? We have a point here where this price is consolidating. I might go into the 5 minutes time frame actually. The area I actually wanted to bring your attention to was this little small area down here during consolidation, and what retail traders were seeing compared to what we were seeing. So the only reason I was on a 4-hour time frame was just literally just to show you that first of all, order flow was down. So you can see we've been dropping. So we've had this push down, right? This push lower. Here, we've had a retracement back up. One of the things to note as well is that whenever you get a break in market structure, something like this, right? You see this low got taken out here. So this low got taken out right here. You always look back to the origin of the break. This is where you'll be looking to cash an entry to then take it lower, and you can see price then dropped that low. So in other words, you can see prices breaking structure to the downside, then it retraces and breaking structure to the downside. Now, in saying all of that, let's go back to the 5 minute time frame. You can see this was just the low of that push where I pointed out, and now it brings us to this point here where price is consolidating. And normally during consolidation, what do you think retail traders are doing at this point? What do you think is happening at this point? As you guys know, what retail will do is they'll mark up their support and resistance zones, because that's one of the best things ever. Support and resistance, support and resistance. That was the very first thing I learned in my whole trading, was support and resistance. And the thing worked out. Sometimes it was iffy. Sometimes it will blast a little bit past your support, then go back into your, it was just off. It was never ever solid. There's going to be points where price is bouncing from. I'm just going to do it from here, and I'm going to change this to a different color. Let's go range. Okay, there we go. Lovely. We have a point here where price is rejecting from. Price is rejected from multiple times, and so in other words, that's going to be like some kind of resistance. This is according to retail traders. This is not how I trade, just so you guys know. Then you have another one here. You can see how price is bouncing off of this low and is rejecting here as well. We have another point here as well. You can see that there's like another point here, this point here too. So I'm going to keep it like that for now. I could get into the nitty gritty and start picking out all these little areas here like this too, because you can see prices bouncing off of rejecting downwards and pushing up. We have some support and resistance levels, and then what would normally happen is after price bounces off a zone and you get a rejection, what would retail do? Retail would normally jump into a position thinking that this is a double bottom. You'll either get some people jumping off early, or you get like the little rejection candle. We get a nice push, and they would have said this is an engulfing candle because it engulfed the other one, and then this is a great place to jump in. They'll either put their stop loss beneath this low here, maybe a 10 pip stop loss, or they're trained to put it 20 to 30 pips, 30 pips max. They'll normally go for some kind of 1 to 3 trade, something like that. They could have gone for 1 to 2. Let's just say they went for 1 to 2 just to make the chart look a lot cleaner, and it kind of aligns up with this thereabouts this high. Or what they could have done if they wanted to stay in line with the trend, price is dropping at the moment. What they could do is this: they could have gone for a short position. They could have done something like this. When price came up to here once, really clean up this zone here. This one, I believe I should have brought a bit lower, right? Something like this. I think that looks a lot cleaner over here. And you can see how price is rejected off this level twice. We've got a nice rejection candle. We're going to be jumping in. We're going to be putting our stop loss above this high or 20 pips. So let's just say 20 pips, because that's like the standard, 20 to 30 pips for retail traders. And they're going to go for 1 to 2. Something like a 1 to 2. First of all, I've not really put the replay mode on, but you can see what would have happened if you had jumped in with this from this double bottom, or even if you use this one and you put your stop loss beneath the low or within 20 pips, you would have been stopped out. If you wanted to stay in line with the trend, because the trend is your friend, stay in line with the trend, and you wanted to jump in for a sell for continuation because price is dropping, then you would have jumped in, let's just say you would have jumped in here with that rejection candle off of this zone. You can see price is struggling within the zone. We break through the zone, we come up for a retest, and then we created a double top at this retest, at this resistance zone now, this support now turn resistance zone, and then you would have put your stop loss, let's just say, either if you're aggressive, you would have put it above the high, the closest high. If you was not that aggressive, you would have, you know, maybe put it 20, 30 pips or so. And as you can see, I've only just been very conservative. I've done 1 to 2s. Normally they go for 1 to 3s. So what can you see here? You can blatantly see that price now, look, they would have been taken out 2 times. They would have been taken out twice. Another thing retail traders would have seen, I'm just going to give you all of this right now. So the third thing that retail traders would have seen is if retail traders were bullish at this point, for whatever reason, they would have dragged their Fibonacci tool from this low to this high right here. Okay, I don't know, my computer's really slow right now. The low to the high, low to the high. So they would have dragged their Fibonacci tool. They would have dragged their Fibonacci tool from the low to the high. And by the way, we are all retail traders. It's just that we trade based off different concepts. Just letting you guys know. And by the way, I have nothing against retail traders. Retail traders are absolutely blessed. They're fine. Look, some of them win and they get theirs, you know, and it's completely fine. They would have drawn the Fib from the low to the high, and it price would have retraced back to that golden 61.8 Fibonacci zone. Golden. So this is why normally they believe that the Fibonacci tool is just an amazing tool, because it rejected off the 61 and that's all you needed. They would have put like a stop loss beneath this low. They would have put it 10 pips beneath the 78. So that would have made that probably about 69. 10 pips beneath that 78.6 is roughly about just beneath the low. So this is what they would have done, and they most likely would have gone for like a 1 to 3 or something like that, right? So let's go to 1 to 3. Let's really adjust that to a 1 to 3. So that's the 1 to 3 right here. So this is what they would have done. And so first of all, they jumped at the 61.8 Fibonacci. And so this is when they believe it's the golden zone, you know, because anywhere between the 61.8 and the 78.6, this is an amazing zone. This is it. This is the golden zone. And look, I'm not mocking you guys. It's just, you know, what I do. I just move my hands a lot. But anyway, this is what I used to do back in the day. When it moved 10 pips in profit, I was so nervous that I'll move my stops to break even. Okay, 10 pips. If I was trying to be holding it down, then 20 pips, I'll move my stop to break even. If retail concept traders hadn't moved their stop loss at that point, what they would have done is the moment it broke this high right here, this is when they would have moved their stop loss to break even. So in other words, you can't lose on money. And you know, if you're one of the traders who like to take profit quickly, you also would have taken some kind of profit off or close off the trade here. If you did that, then kudos to you. That's great. It's amazing. But if you didn't do that, you would have left your stop or moved your stop into break even, or you would have been trailing your stop loss. But if I just move out to the side now, you would have seen here, look, they came right for the people who moved their stops to break even. And guys, if you can't tell, yeah, I do have a cold, and that's why I sound a bit stuffy, but your boy's Gucci other than that. If you had moved your stops to break even by 1 pip, so let's just say, look, the 61.8 Fibonacci came in at 1.3886. Let's go to 3887. Where did this come to? Let me just quickly go there. The low came to 1.31871. You would have been stopped out break even. So in other words, what I'm trying to show you is that, look, when you're doing retail trading, it becomes really tough. If you're not taking profit quickly, you're going to see price go into your favor, and then it will come back down to kind of hunt you out, stop out your stop losses. There's going to be the occasion as well where it just goes to the moon, like you get like an equal low and it'll just go to the moon or just plummet. In all my experiences, price will push up a little bit and then it will come back down for my stops every time. And if I had broken even, it was taking me out break even, and then it will go in my favor. So this is what retail traders would have seen, and it would have been a struggle. It would have been stressful, because this is what the markets do. They stress you out like that. But now I'm going to show you guys what smart money or institutional traders would have seen in this exact same chart. I'm going to delete everything. I'm going to go up a time frame. Let's just go to, it doesn't really matter. Let's go to the 50-minute time frame. Do you remember I was telling you guys about, this was the high up here, the high over there, and then it pulls up to the origin of the break, and then it breaks again all the way down. I just want you guys to bear that in mind for now. And there would have been a lot more in this, but I'm going to just break down just the bits, you know, I can actually share with you guys. First of all, look at this date. The date is the 30th of November. This is a monthly low. You can see this is the monthly low. This is a monthly low, right? If I just expand all the way out, you can see that's the 30th of November, and now we're in October, as you can see. So this is a monthly low. So we have external liquidity, we have a monthly low. That's the big boy time liquidity. So I'm just gonna just put previous month's low, right? And I'm gonna put this money sign here so you guys can see it, and I'm gonna put it at the bottom. There we go, make it bold, and we're good. What else do we have? We also had equal lows down here. Look at what price had done. This is what smart money traders would have seen, right? So in December, we took out the previous month's low. Okay, we took out the previous month's low, took out the previous month's liquidity, and we also took out this low here as well. We also took out this low in December. We took out these equal lows as well. So in other words, we're taking liquidity to this downside. We've taken that big boy liquidity. We've taken that external liquidity, and now we want to see price look for the opposing liquidity. So where else is the money? There's going to be money above every single one of these highs. There's like a little trend line here as well, as you can see. And you guys know that above this trend line, it's a liquidity pool. Okay, I'm just gonna put LP for liquidity pool, right? And I'm gonna put the pound sign. You know, your boys from the UK. And I'm gonna go top, boom. And I'm gonna put it right in the middle, center. There we go. And it didn't really turn out how I wanted. There we go. They're creating some kind of liquidity pool on top as well. So we've just taken out external liquidity, we've taken out equal lows, and now we're looking for that opposing liquidity. And we know that there's going to be liquidity on the top side because look, price is respecting this retail trend line here. And whenever price touches this trend line, as you can see, it holds. And so when people see the trend line holding, what they're going to do, they are going to be jumping in at the touch of the trend line, placing a stop loss either 20 to 30 pips above or above the previous high. That's what they're going to be doing. And so we know there's going to be liquidity up here. And so this is why we are targeting these levels. We're targeting up here. So now when we go back to the exact same section that we were looking at, where the retail traders were looking at, and they were drawing up all kinds of retail support and resistance zones, we're not looking at that stuff. What we're looking at is we're looking at signs to go long to now attack the opposing liquidity. So over here, yes, I was in a buy from here, but we've not come to talk about that. So you will see that on my Instagram screenshots that I was in a buy from here as well. The reason this 61.8 trade for retail traders would have held is only because of this. So you see this down close candle here. We have a down close candle here. So from this very high to this very low, yeah, we have a down close candle. And then look what happens. Price then broke the short-term high that created a leg that ran out these equal lows. So in other words, we're looking at price getting ready to reverse. You can see these little equal lows here. Let's just pull it up here, equal lows. There we go, equal lows. Yeah, price ran out. If I zoom in now, you can see here, the price generated equal lows, they ran equal lows, and then they broke up to the upside. And so already our alarm bells are ringing in our heads, and we're looking to go long. So after we break this high and we break this high over here, price then returns back to the last down close candle, and this is where most likely you would be looking to catch an entry to go long. And specifically within this last down close candle, there was an imbalance here, there was inefficiency here, and price came to fill in that inefficiency and then expanded. So this is where you could have caught that entry to go long. It wasn't the fact that it was the 61.8 Fibonacci. It wasn't the fact that, you know, price had returned back to the golden zone. It was more so to do with cleaning up the inefficiencies that they had left behind, and then price expanded. So this is where you could have caught your second entry. Okay, this is where you could have caught your second entry. And you know the targets. The target for this trade would be to break these highs. These highs are the highs that you're looking to target, every single one of these highs, because you want to attack the liquidity pool. And don't forget, like I said, if this is structure, so let me quickly just draw this up for you guys so you guys can see it. From this high to this low and back up to this high, and then price breaks structure to the downside, where on earth should you be targeting? Here. Why? Because this is your range. From here to this low. I know it looks a bit messy now, but look, this high, yeah, to this low. Because it was this high that broke the structure to the downside. So this is your range from this high to this low. Okay, cool. So you guys know. So basically, this is where you're going to be targeting, because whenever you break structure, you always go back to the origin of the break. So you'll be looking for price to run these highs into this, and then price is going to continue after that, then it's going to drop. If I go down the time frame, let's go to the 5-minute time frame. Let's take this off because my computer's acting so slow. Might be the new camera, I don't know. And guys, there is a new camera, so if the camera's a bit dodged, let me know in the comments. If it's blessed, let me know in the comments so I know. What do you also see? You also see another last down close candle here from this high to this low. So if I just use that and expand it out to the right side, what can you see? And so I was in a trade from down here. I didn't take this one because I wasn't interested. My time of day was off. It was like 5 p.m. I don't trade at 5. I don't look to enter new trades at 5 p.m. But when it came back down the next day during the London session, that's when I entered into the second trade and, you know, took it to the upside. Literally this, let me quickly show you. This when I entered the trade, I entered roughly about these lows, and I had my stop loss just beneath this low here. I think it was 87.6 or something. 87.6, I believe I entered. Well, and I had my stop loss just beneath these lows over here. Just beneath these lows. So this was my entry, and then we was targeting. I'll show you where I was targeting, just so you guys know. This was the target, and then this was my ultimate target. This is right up into here, I believe. It was right up into here. So obviously you could have put your stop loss beneath the low, you could have put it beneath this one too, which is the main thing to put your stop loss beneath, but I was comfortable with this. If I just press replay, hopefully it doesn't start acting up. You know, my system's going wild right now. I'm gonna go up the time frame real quick, 50-minute time frame. But that was my overall target to the top side. But what we were looking at primarily was this high here being beaten here, and this is for the short-term trade. This is where basically you would have taken partials on the trade and then you would have let the rest ride. Just from entry, you know, for this trade, I wasn't down here, so but we're just talking about this one here. From this high to this low, that was a nice juicy 55 pips. And then I'm just gonna hit play to show you guys what happened. I'm not gonna play it all the way. I'm just gonna hit play to show you what happened here. There you go, and as you can see, price is pushing up. The moment it broke this high over here, that's where I took partials. I let the rest ride to roughly about 76 before taking more partials, and then obviously, you know, the madness that happened. Price then went crazy. Let's just delete all of this so you can see it for yourself. You can see what happened. You know, price then came, FOMC came to take us all out, took out everything, my two buys and everything else, and I was pushed even higher, which is intended. Yeah, this was just manipulation. But anyway, family, that is the difference between what retail traders see compared to what smart money and institutional concept traders see. We see the charts totally different. When you start to see the charts in a different way, your trading will improve. Thank you guys for watching the video. Peace.